Why did China's trillion-dollar dream to reshape the global economy collapse into mounting debt and unfinished projects? The Belt and Road Initiative was supposed to be China's grand strategy to dominate geopolitics, yet over 60% of its loans now belong to distressed economies. What went so wrong, and what does it mean for the future of global power dynamics? The rise and fall of the Belt and Road Initiative. When China unveiled the Belt and Road Initiative in 2013, it was nothing short of ambitious. The idea was simple yet monumental. Invest 1.3 trillion into global infrastructure projects connecting Asia, Europe and Africa. With railways, highways, ports and power plants, China aimed to create new trade routes that would rival existing global networks, while cementing its status as a central player in world commerce. The initiative wasn't just about economics, it was about weaving a web of influence, offering developing countries the funds they needed to secure their futures, while tying their aspirations to China's economic rise. But the promise of the Belt and Road Initiative quickly ran into practical hurdles. At first, countries embraced the idea with enthusiasm, lured by what seemed like a golden ticket for growth. Projects kicked off in dozens of nations, ranging from railways in Southeast Asia to energy projects in sub-Saharan Africa. However, many of these came with complications. A prime example is Sri Lanka's Hambantota port, a costly investment that failed to generate the revenue necessary to repay its debt. Eventually, Sri Lanka was forced to lease the port to a Chinese company for 99 years. A stark illustration of how overambitious planning could backfire. Similar stories began to surface elsewhere, with delays, cost overruns, and waste becoming recurring themes. China didn't embark on this journey blindly, and its reasons for launching the initiative ran deeper than global goodwill. At home, an overcapacity problem loomed. China had spent years building up industries like steel, cement and construction, but its domestic demand had plateaued. The Belt and Road Initiative offered a way for China to keep its factories humming by exporting resources, expertise and manpower. On another level, China saw an opportunity to put its enormous foreign currency reserves to work. By providing loans to countries in need, China could not only earn returns, but also secure access to critical resources like oil, minerals, and rare earth metals. Each loan was strategic. Every port or mine entangled China more deeply in the economies of its trading partners. Yet, instead of following traditional lending models like those of the IMF, China swapped strict conditionalities for looser terms. On paper, this model promised accessibility to countries that had been underserved by global finance. In practice, the lack of rigorous financial safeguards opened a Pandora's box of risks. Many of the recipient nations already had fragile economies, and China's large loans made them even more vulnerable. These investments lacked a long-term perspective, relying almost entirely on a fast return. And when those returns didn't come, the cracks began to show. Fast forward a decade, and the optimism has dulled into a sobering reality. Over 60% of countries involved in the initiative are now classified as being in economic distress, driven in part by their inability to manage the mounting debt. China, in turn, has been forced to step in with bailouts, more than $240 billion globally since the initiative's launch, to prevent its loans and the countries holding them from collapsing entirely. These bailouts not only strain China's financial resources, but also expose deeper problems with the initiative itself. The Belt and Road Initiative was intended to be a symbol of China's economic strength, an answer to Western-dominated development models. Instead, it now highlights the limits of unchecked growth and the risks of investing in volatile markets without robust strategies in place. For China, every bailout and failed project underscores a vulnerability, one that other global powers have started to notice. With its external challenges piling up, the pressure on China's domestic economy is mounting. How has this international strain come to shape the future of China's internal finances? That's where things get even more complicated. China's debt crisis and domestic strains. The strain of the Belt and Road Initiative's financial missteps has come crashing down, not only on the borrowing nations, but also on China itself. Over $240 billion in bailouts to struggling countries has left China in a precarious fiscal position, raising questions about how much longer it can sustain its role as a lender while dealing with economic challenges within its own borders. These bailouts are not just numbers. They represent a significant drain on the foreign reserves China relies on to stabilize its economy. What once seemed like a strategic use of hundreds of billions is now a financial liability, limiting China's ability to respond to its own pressing needs. Domestically, the ripples of this global financial strain are impossible to ignore. Economic growth, which once seemed unstoppable, has slowed to a crawl in recent years. The real estate sector, a pillar of China's economy, is facing severe troubles with a slump in home sales and rising developer defaults. The unemployment rate among young people soared to over 20% in 2023, before China decided to suspend publishing the data entirely. The combined impact of these factors has created a cocktail of uncertainty that has shaken public and investor confidence in the country's hallmark growth-first financial model. China's allocation of funds for risky foreign loans has also directly impacted its domestic economy's flexibility. Mismanagement of foreign reserves, poured into projects that are now yielding little to no return, has tied up resources that could otherwise be used to stimulate domestic development. Take, for instance, industries like construction, cement, steel, and aluminum, sectors that initially rode the wave of activity generated by Belt and Road Initiative projects. As the initiative has faltered and opportunities abroad have shrunk, these industries are now struggling with unused capacity and weaker demand. Billions of dollars that propped up steel mills and manufacturing plants are now contributing to China's growing debt-to-GDP ratio, a figure that increases reliance on domestic borrowing even as global lending markets remain wary of China's financial health. This growing debt burden isn't a small problem, it's a looming giant. China's total exposure to the BRI is estimated at $1.3 trillion, with nearly $780 billion in loans at risk of not being repaid. To put that into perspective, this amount is equivalent to the entire GDP of Switzerland. And worse, many loans are so financially unstable that they've hit junk status, further amplifying the risks. The country's debt-to-GDP ratio continues to climb, suggesting structural stresses that threaten long-term stability. For a nation that once paraded its economic model as an alternative to the West, this is a hard-to-ignore setback. Foreign investors and analysts are now scrutinizing whether China's high infrastructure spending boom has actually created sustainable growth, or if it has produced more problems than it's solved. China's decline in financial confidence carries a global ripple effect. The slowdown in what was long considered the world's most important growth engine is reshaping international trade and investment flows. Countries that previously depended on China for financing large-scale infrastructure projects have started to reconsider their trust in Beijing. Trade imbalances, currency pressures, and a reordering of supply chains signal that other global players may fill the void left by China's faltering ambitions. Domestically, these external struggles have further complicated China's challenges. The burden of servicing its international debts limits the fiscal muscle it once had to invest in stabilizing key sectors like technology, consumer markets, and industrial production. What's particularly striking is how far public perception has shifted. The economic model that grew at breakneck speed, lifting millions out of poverty and transforming urban landscapes, is now under intense scrutiny. And it's not just China that faces the consequences. As China wavers, global businesses reliant on its output, whether in manufacturing, materials, or infrastructure contracts, feel the squeeze. From Asia to Europe to Africa, nations that once saw China as their primary economic savior are now grappling with what its faltering growth means for their own futures. This unfolding situation is squeezing confidence not just within China, but across a global network interwoven with Beijing's financial web. With its global strategy backfiring and domestic strains deepening, China finds itself at a crossroads. So, how is it attempting to reorient its approach to regain control? That shift may determine both its future standing in the world and its ability to address the challenges mounting at home. The shift in global economic power. China's recent economic struggles have sent ripples through the global stage, raising questions about the future balance of power. For years, the Belt and Road Initiative, along with its meteoric economic growth, positioned China as a financial and geopolitical heavyweight. But now, with slowing growth, mounting debt, and diminished confidence in its economic model, other nations are stepping in to fill the void left by Beijing's waning influence, particularly in developing markets. Take India and the United States, for example. Both nations are actively courting developing countries that once aligned with China. India, backed by its growing economy and strategic position, has amplified efforts to establish itself as an alternative partner in trade, technology, and infrastructure projects. The United States, keen to offset China's dominance, has been further solidifying alliances in Asia and Africa, even launching initiatives like the Partnership for Global Infrastructure and Investment, one directly aimed at countering the Belt and Road Initiative. This strategic repositioning underscores a shift in global power competition, particularly as countries weigh their options in a post-COVID world with an economically constrained China. This shift in influence has also impacted global energy dynamics, often revealing the complex balancing act between economic opportunity and political strategy. Canada's growing oil exports to China are a clear example, with the United States reducing its reliance on foreign oil thanks to increased domestic production and the cancellation of infrastructure like the Keystone XL pipeline, limiting Canadian exports southward. Canada has turned to China as a major market for its crude oil. This move reflects not only the shifting economics of energy trade, but also the geopolitical recalibrations that come with it. China's insatiable demand for oil had provided Canada's energy sector with a critical outlet, compensating for shifting priorities in North America. However, Canada's deeper energy ties with China are not without complications. On one hand, exporting more to China brings financial gains, boosting an oil sector that accounts for a significant piece of Canada's economy. But on the other hand, it places Canada in a precarious position, caught between its largest trade partner, the United States, and a rising yet increasingly fragile China. The US keeps a close eye on such shifts, given its broader strategic rivalry with Beijing, amplifying tensions in the region. For Canada, this isn't just about economics, it's about diplomacy and navigating relationships with two powerful nations that often have opposing goals. These evolving partnerships are emblematic of the wider economic reordering underway. China's financial setbacks, compounded by the failures of its global infrastructure initiatives, have created opportunities for other powers to reassert themselves, realigning trade routes and alliances that had once appeared increasingly China-centric. This power vacuum is particularly evident in infrastructure markets, where competitors to the Belt and Road Initiative are stepping in. By offering alternatives with greater transparency and less financial risk, Western economies are gradually redirecting attention away from Beijing's model of development financing. At the same time, questions are growing about China's ability to play its former role as a global lender of last resort. This has critical implications for smaller countries that relied heavily on Chinese loans. If China reduces its external financing, nations that are already grappling with debt from earlier agreements may have to look elsewhere for support. While Beijing could attempt a recalibration of its global economic priorities, choosing to focus on higher quality projects with lower risks, it remains unclear whether this will be enough to restore confidence in its strategy. Rather than a simple pullback, China's current struggles could signal a far-reaching transformation in the geopolitical landscape. With weakened ability to outspend competitors, Beijing may pivot to more subtle forms of influence, such as leveraging technology exports, but it will face stronger resistance from nations eager to reduce dependence on one dominant power. This transition is not just about challenges for China. It opens the door to a new era of competition among global powers, particularly in strategic sectors like infrastructure and energy. How the world adapts to China's evolving role will shape the narrative of global leadership in the coming decades. Is Beijing retreating as a sign of weakness or simply recalibrating for a more calculated approach? As the dust settles, it's clear that as China tightens its grip, domestically, its global presence faces fresh tests from both rival powers and a restructuring global order. The implications of this shift are just beginning to unfold. Conclusion: China's economic challenges are reshaping more than its domestic future. They're altering the very balance of global power. With 60% of Belt and Road Initiative loans in distress, totaling $780 billion, Beijing faces growing financial pressure as rising interest rates add to the burden. The ripple effect has left many projects incomplete, straining the economies of borrowing nations while weakening China's influence abroad. Will Beijing pivot its strategies to regain credibility, or is this a turning point signaling its decline? The future of global economics now hinges on how countries respond to China's evolving role and the opportunities its challenges create.